So this video is going to be very strictly for my new student. I will be outlining how to navigate the start of the week and how you will plan to execute for the rest of the week. So from Sunday, 6 o'clock p.m. New York time, which is 3 o'clock in PST, up until Friday, Friday end of session, right, which is going to be 4 New York time, but 1 o'clock here in Cali, PST time. First thing, always, will be to mark out Sunday, 6 o'clock. Then you want to mark out Monday, 12 a.m. Now, why do you want to mark out Sunday and Monday at 6 and 12? Well, market doesn't really open until Monday, 12 a.m. That is the new week true open at midnight. We focus on Sunday and we use Sunday as kind of a tool of measure. We use Sunday to measure what should we anticipate for this week. Now, there's a lot of things that Sunday can do. Sunday can move uniform, meaning it doesn't really do anything but move sideways, right? We have times where Sunday could do what it did to this time, which is just gradually increase in price. So a slight rally. We could see the opposite, a slight decline, right? It doesn't necessarily matter right now because it's a bit expert level to try using it in the week. But for now, just use it as a tool of measure to understand how volatile could we be this week. Counting the range of Sunday open to the high or to the low, we have 150 handles, 150 points that it moved during Sunday alone. That tells us potentially this week could be a very volatile week. That's it. That's all it tells us. So now we take every midnight, every 12 a.m. New York local time, we mark it out as a new day. So we have Tuesday, we have Wednesday, and so on, right? The point of this is to try breaking down the goal is to try breaking down the weekly candle. Through a 15-minute time frame. Time frame perspective. Okay. So on a 15-minute time frame, our goal is to break down the week, right? How are we going to navigate through the week off of the 15-minute time frame? That's the goal. You start from Sunday. You start the trading week on Monday, though. Okay. Typically, what we want to see is Monday accumulation, Tuesday manipulation, Wednesday distribute, Thursday distribute, Friday X representing reversal or continuation. Sometimes you could get from last week a continuation, so you get X, then you get Tuesday accumulation, Monday manipulation, uh, Tuesday accumulation, Wednesday manipulation, Thursday distribution, Friday distribution. Sometimes you could also get accumulation, then manipulation, distribute. Okay? This is in the sense of Monday through Friday. First scenario, you get 2 days of accumulation, Monday and Tuesday. Wednesday, you'll get manipulation. Thursday, distribute. Friday, distribute. Sometimes you get Monday, reversal or continuation of last week's price action, straight out the gate, right? So you don't accumulate at all on these days, on Mondays, and you distribute instead. Then the following day you accumulate. Then you will manipulate. Then you distribute on Thursday and Friday, Wednesday, Tuesday. Typically, the most common and the most that we anticipate for is accumulation on this day. So what I'm thinking is going to happen is we opened here, accumulate, right? Accumulate. We end somewhere here, right? For the day. Then Monday, we're expecting to manipulate, right? There's chances that we accumulate more, but we're looking for some sort of manipulation. Where? Well, when you go to a weekly time frame, what are you expecting out of price action? Are you expecting price to, let's say this was the week, right? Previous week. We have a down close candle. Down close candle. For this week, are we expecting lower prices or higher prices, right? Higher prices or lower prices? Based off that, in this context, we're expecting lower prices. So if we're expecting lower prices, where do we want to see manipulation? We want to see manipulation above yesterday's accumulation day or last week's accumulation. Now, if in this case the wick is up here, yet we have this entire body, right, where we opened, are we likely to tap into all of this if this range in this candle is very expansive, right? So this is like 200 handles. Are we likely to manipulate and then sell? Most times, no, we won't. What we will get instead is either a fair value gap opportunity as an entry point for price to tap into, right? Tap into, then reverse, creating that wick as manipulation being our entry, to then whereas the rest of the week, this move right here was Monday, right? So this is last week's candle. This is Monday. We're within a fair value gap, right? Tuesday opens we're in that fair value gap. We're expecting lower prices for the week. So we're selling now as this becomes our entry. Now we hold from Tuesday, to Wednesday, then to Thursday, being the low, creating that wick, because Friday, either you get Friday reversal, right? Or you get a continuation, which it would come all the way down here and then wherever it closes, right? That's essentially your thought process on utilizing the previous week's price action to plan out for this week's price action. So, again, this being our accumulation, if on a higher time frame, let's remove these drawings. We'll go to a daily time frame. From a daily perspective, right? Let me go to a week to make this very, very simple. Okay. Now for my student, this was the previous week. This candle right here. The previous week from this candle was extremely bullish. This was elections. And this week, we would have either anticipated even higher prices or for some sort of fill, because we left from this point forward, could have been an imbalance. It's the same case for this week, right? But you can only see it from a daily perspective. We have this imbalance. Now, because there's a gap right here, we have to include it. But you see that, right? That gap as the imbalance. So on a daily perspective, when we're planning for the week, are we expecting to go higher in prices or lower, right? We expanded last week, being elections. Last week, we came down into that imbalance to fill it. So now we're this week, are we likely to expand or are we more likely to continue distributing downwards? Because is there some sort of liquidity pool that we need to sweep? In my opinion, I'm expecting lower prices. With what's happening as regards to elections, economic news, and overall price action, it's hard to tell a clear draw on liquidity, because yes, we are entering Trump's presidency. A lot of people are expecting, market to continue rallying, or hold on, let me just make sure I'm recording. Yeah. People are expecting prices to rally, right? The market to rally. But if you look at it from a time perspective, right now we're midway November. We still have December, and then we have half of January until President Trump takes his seat as the new president. In that time frame, a month and a half, technically 2 months, are we likely in 2 months to continue pushing forward for higher prices, or are we likely to sweep some sort of liquidity before that happens so that we continue? I think this week will determine whether or not we continue being bullish or bearish for the rest of the 2 months, simply because I would not want to see a new all-time high unless it forms SMT at the higher time frame. Real quick, what is SMT? SMT divergence is when price, when paired with NASDAQ and ES, when they don't follow suit with each other. We're going to show an example of what that should look like. And we'll actually use a very obvious point. Okay. Let's see. Okay. In this point of time, Friday, 9th, August 2024, till Friday, 6th September. Friday 9th to August 6th. When we look at these 2 points in price, typically NASDAQ and ES follow suit, meaning if the NASDAQ makes a new low, ES, being S&P 500, should also make a new low. In this case, NASDAQ swept this liquidity, making a lower low than Friday 9th, but on ES, we made a higher low, failing to sweep liquidity on Friday the 9th. That is what we call SMT. 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 How is this helpful? SMT outlines that price is not in sync between these two markets. That means typically where SMT is formed, saying in this case, SMT is formed at the lows, right? You can expect higher prices, a reversal, because price is not inclined to selling, right? Now, if we had SMT, right, which we did up here, right, from the 22nd till 22nd to the 3rd, we had SMT, right? That was this drop down. See that? SMT, where we made on NASDAQ the high on ES, to where we dropped lower on NASDAQ, making a low, failing to sweep this. This is our high. Yet on ES, we came up past that point, barely, making and forming a new high, a higher high. That tells us price is inclined to moving the opposite direction because price is no longer looking bullish. To them, where we get that lower end SMT to the bottom, right? When we get this SMT, then prices reverse and move higher because price is no longer inclined to lower prices. That's how we utilize SMT. So going back to my statement, I am not inclined to higher prices unless, if we continue for this week bullish, I'm not inclined to higher prices unless we don't get SMT. If we get SMT, then even more so, I would be inclined to lower prices. And then for the next 2 months, I will be thinking about where is price likely to draw in these pools of liquidity. We have new day opening gaps, new week opening gaps, and imbalances, right? Imbalances in the market. The market has to come down eventually and clear these. And I want them to do it within those 2 months so that for the next 4 years, or at least the first year, we start January by rallying in the market. So essentially, I'm anticipating before, let's say this is when Trump is in presidency, I'm expecting price to bounce around a bit, come down into some sort of liquidity, right? Within this range, come up, give us a sign at the bottom, right? SMT, that it's respecting this thought and this theory of no longer going lower in price and now aiming for higher prices by the time it's his presidency, right? That's essentially what I'm looking for 2 months out. So for that to happen throughout the weeks, what are we looking for? That's outlined through our weekly analysis and outlined with AMD: accumulation, manipulation, distribution. Currently, right now, we're coming down into this 1 hour fair value gap to disrespect it. What this tells me is that we're no longer bullish, at least for today, right? Now, price can just chop and slowly move up. That's fine. But I'm not inclined to looking for bullish setups unless during London we see something that says otherwise. What I'm inclined to see now is when we open on Tuesday, get some sort of liquidity sweep at these highs or whatever London presents us, maybe a fair value gap, maybe a sell above this high as manipulation or something, right? To then enter and seek lower prices at these lows, but also these points in time where I'm expecting price to come and fulfill. Now, for my student, if this is confusing so far, replay the video now and take notes of what was confusing and ask me, because it was a lot of information so far. Now is the time, I think, to refresh essentially what we came in here at the beginning of the video to talk about, and it was to outline the rest of the week. If we're assuming Mondays are accumulation, right? Forget all this price action from this point. We're only focused on this area. I'll make sure of that. We're only focused on this area, right? This is Sunday. This is Monday. This is Tuesday. When it comes to Tuesday, what could we expect to look for? Well, let's say for whatever reason, price decides to continue chopping, right? Let's get rid of all this. I don't know what that line is. Let's say price continues chopping in this area, right? And we open on here. We open here. I'm expecting this fair value gap to be left open. I am also expecting when it becomes not at 12, but at 10 o'clock, our kill zone, when we're looking for entries, I'm expecting price to come into this left open fair value gap and sweep this liquidity to then place my order and sell, targeting these relative equal lows, right? This would be the draw on liquidity now. When we come into Tuesday at the 10 a.m. session, New York Open. Or not New York Open, but New York AM session, I should say. New York Open is at 9:30. Okay. That would follow suit with Monday being manipulation into, right, this fair value gap and past these orders, because everyone's trying to put some orders in the afternoon, accumulated orders. So price will come down, come back up, we'll enter here and sell. That is what we're looking for, unless we're told otherwise by the time market opens tomorrow at 9:30. Okay. If our opportunity isn't there and things have changed, then we have to adapt and read price action for what it is. Price action will regardless do what it's set and planned to do. It is up to you as the trader to properly read the graph and the candlesticks to anticipate the right move. If you're not in profit or right, then you did something wrong and you read it incorrectly. You missed something on one certain time frame. It only takes one thing on one time frame to mess up your whole confluence or your whole setup. So that's why it's important to outline everything. And the more aligned you are with the higher time frame bias, the easier it is to catch these trades. If you told me, based off of this, I'm bullish, right? Because this is extremely bullish. But if I told you for the past 4 hours, we've been extremely bearish. So why would you be bullish now? It makes no sense. You fight against the current. You need significant confluences such as turtle soup or SMT at the lows to change your thought of being bearish, right? There is a possibility that we don't get that sell and we continue higher. I'm aware of that. And I'll be looking out for that. What would consider us to be bullish instead of bearish in this extreme bearish market so far? Well, one, as stated, if we get SMT. Two, if we get a turtle soup, which is if we decide to sell, right, following the plan come Tuesday. On Tuesday, there's a phenomenon that I like to refer to. Tuesdays and Thursdays can either create the high or the low in the market. So if we sell on Tuesday and we fulfill our initial draw on liquidity, but then come to Wednesday, we look bullish and we're looking to rally, right? Seeking these relative equal highs. That could also be a possibility. And this would then turn into turtle soup. So if price were to come down into here, right? Turtle soup is when you have an accumulation of orders. This would be the accumulation of orders to then where price manipulates down into an old low or old high, in this case, a old low, within a higher time frame confluence, such as a fair value gap, right? Fair value gap right here on an hourly time frame. So if price wants to sell down and then tap this, depending how it taps into this level of this 1 hour fair value gap, if it decides to respect this middle line, the middle line in every box or in every range is equilibrium. If it decides to tap equilibrium right on and then give us some sign of rejection, we will wait for price to break out of this turtle soup or within and give us a retracement, meaning another fair value gap opportunity, right? Here, fair value gap opportunity, also respecting this, right, accurately. Okay, it's important that we find setups that respect our fair value gaps on the equilibrium, meaning the 50% mark. If it doesn't, it's probably not a high probability setup, meaning it is not an A plus setup. To them where price will expand and reverse. That is how you catch turtle soup. You catch your entry being at the lowest point possible, expecting a reversal. Because that is what we're expecting or anticipating maybe after Tuesday, we won't be focused on it. We are still focused on the idea that this could be the draw on liquidity. This is an accumulation day, and we want to see this high be left open if we want to be bearish tomorrow. I would not want to see this gap return to at all if we want to be bearish tomorrow. If not, and if we end up coming past this, then price would have to sweep some sort of liquidity up here before we sell off into this fair value gap or into this fair value gap, or some sort of PD array on a higher time frame so that we understand the higher time frame draw on liquidity. This is all internal liquidity compared to the higher time frame. On a daily bias, this is a one huge down candle. But from the 15-minute perspective, this is just accumulation. From the week perspective, we want to anticipate where will the continuation of the week go. Are we going higher or are we going lower? It's only clear if you outline it every morning at 12 a.m. You have to constantly remind yourself, where are we in the weekly profile from a 15-minute perspective? Going back to the goal. The goal is to be able to outline the weekly candle based off of a 15-minute perspective. That will be it for this video, so we don't make it too long and too much information, so that you can refer to this specifically on how to outline your weekly perspective from a 15-minute, or the weekly candle from a 15-minute perspective. Now, you don't have to stay on a 15-minute. You can view your weekly profile from a 1 hour perspective. That's totally fine. Just understand that your candles are going to be less, and it may be a little harder to understand where your draw on liquidity is, right? Because this gap is so large, and because we have not tapped into that 50% mark, it's hard to really tell if this is going to be the highest point of our sell. Or will we come into this point again and then sell, creating SMT as well, right? Like this, creating SMT and then selling downwards. All of this it comes down to experience and learning from your mistakes. To my student, you're going to make a lot of errors trying to read price action and anticipate certain moves that don't pan out how you expected it to, although you may have thought you did everything correctly and you were reading it properly. It happens. The more important thing that you have to get out of that situation with is the experience of what price action did. The more times that you just watch price action do things, the easier you will be able to fulfill your higher time frame narrative. You won't be afraid to anticipate some of these things and place your trades. Right now, the main focus should not be money, because money will eventually come as you learn to utilize this skill. Your main focus has to be gaining market experience. The more trades that you can watch play out, and the more times you can watch these candles accumulate, manipulate, and distribute, the easier it becomes to identify points in time to trade. Again, with that will end the video. If you have any questions or concerns, please reach out or leave a comment. I'll be happy to reply to them or answer them in the next video. Take everything day by day. Me starting off starting this, I didn't know what to expect, and it was a lot of information, which is why I stuck my head and dug my head into the ground, buried in all of this for a whole month, from open to close. I was watching the market, watching videos nonstop, watching the market's behaviors. It's only when you go that far to really watch price action and what it does are you able to read and understand it. So don't beat yourself up if you don't understand what I said today or what happens for the rest of the week. That's fine. You lack experience. You're not ready yet. But that doesn't mean you can't be ready ever. The more time you put into this, figuring out how to read it, the easier it becomes. Thank you again for watching this video. Hope you enjoyed. Leave a comment, like, or subscribe. That'd be very much appreciated. Take care and be safe.